Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
This is ETF Market Insights. I'm Danielle Nuzzle with BMO Exchange Traded Funds. Great to have you back as always. Great to have you here on this Friday afternoon, or have you tuning in live on our YouTube channel. Thanks to all our viewers and audience members for giving us the time every week to chat about ETFs and investing. But before we get started, just a reminder, we are not here today to give you any advice. We're not here today to provide any recommendations. That's not what this session is about. We're all about providing you information, updates on the current marketplace from the lens of a Canadian investor, with added information on exchange traded funds so that you can be empowered to make the decisions for your own investment portfolio and have all the tools and information you need to manage your investments. Well, today's topic is on the banking sector, and we have Chris Heeks, who's taking a break from portfolio managing today. He is on the ETF desk here at BMO. It's great to have you here back today, Chris.
Thanks, Danielle. Great to be here.
Thanks, Chris. And I just want to remind everybody, if you haven't already, check out our YouTube page and click subscribe, throw those alerts on, because what that will do is it'll help us grow our content and continue to provide you with these sessions every single week. Our 1 minute ETF update today. Well, today we are talking about a sector, and that's the banking sector. And so I decided to show you what performance has looked like recently among all the different sectors. So what we're looking at here is the 1-year return and the 3-month return of several different sectors. And you can see the Canadian banks have been strong on the 1 year and on the 3-month. And really what we've seen is ever since, rolling back the calendar a bit to November 2020, when Pfizer announced that vaccine news, and we got the first glimmer of hope that there would be an economic reopening, we've seen a resurgence in Canadian banks, and this really hasn't slowed down since that news. And then, of course, you see sectors like energy and materials have been very strong of late. I don't think that's any surprise given what's going on in the world right now. But, as a reminder, what this chart doesn't show, so it does show recent performance, it doesn't show volatility. And if we were to map out volatility, you'd see that the sectors like energy and materials do come with a little more volatility, whereas a sector like the Canadian banks, a little less volatile than those cyclical sectors, so something to keep in mind. Now, the banks have been top headlines lately, and for many different things. We saw earnings reports just come out a couple weeks ago, which we're going to get into shortly. We saw the banks resume dividend payments at the end of 2021, I think to the tune of about 15% on average increase across the board, across the big 6 banks. So a lot of headlines, but a new one hitting us this week in Canada with that recent announcement of that working agreement between the NDPs and the Liberals is putting into focus this idea of a recovery dividend, which is actually might be a tax on financial institutions that make over $1 billion in net income. Chris, can you break down this recent headline for us and tell us how it's going to impact this sector going forward?
Yeah, for sure. And not to start our conversation off on a bit of a downer, but I think a couple bank investors, some bank investors are a little concerned about what this working agreement means. But as we remember, Trudeau, in the run-up to the election, he announced a recovery dividend, which is not a dividend to shareholders, it's actually a dividend to the government. So that's a tax. He announced a tax on financial institutions making more than $1 billion a year, which of course the banks, the big 6 banks, at least they all fall into that category. And the idea was that they benefited in the pandemic, and this was going to be, help pay for some of his spending initiatives. So the banks did sell off a little bit in August, back when he first proposed that. And then it's just one of those things that's come a little bit more into the focus. So I think with the NDP and Liberal coalition or working agreement, this is something that's a little more on the radar. But without diving into the weeds, we'll talk more as we go on, I'm sure. It's a relatively minor part of the bank's earnings, what's being proposed, somewhere around 3-4% of total earnings. I think we'll see, as we talk through this conversation today, we'll see there's a lot of reasons why we like Canadian banks historically and going forward. So it's this I think will prove to be a bit of a side point as we move through the year.
Great. Thanks for breaking down that headline for us, Chris. I know that that's recent news, so it's really nice to hear your input on it and how it is affecting those bank stocks and those bank ETFs. But if we look back, so here we're looking back historically at the Canadian banks' performance, and we pulled this Bloomberg chart. I know it's a little bit small to see some of the labels here, but Chris, could you walk us through this? And it really does showcase how banks can be considered for growth.
Yeah, absolutely. So obviously known for dividends and dividend growth, but capital return as well. So look at that white line versus that orange line. Staggering amount of difference, over this time frame going back about 40 or 30 plus years at least. If you look at the banks over the past 30 years, they've outperformed the TSX index by about 4% a year. And certainly you can see what 4% a year means over the long term compounded. Can make a big difference because the total ending value is almost 4 times on the banks what it is on the index. And also the S&P 500, which as we know has performed so well, Canadian banks has outperformed that over the long term with, as you mentioned, less volatility as well. So again, historical returns, not predictive of future returns, but also there's a saying in investing that trend can be your friend, and the banks have a long and storied history of being, not just great dividend payers, but great accumulators and builders of capital. So I think this chart really shows it, doesn't it?
Yeah, absolutely. I think when we show this to a lot of our colleagues and others on the street, people are surprised when they see just how strong the banks have been when we look back. And of course, everyone has been focused on the last 10 years with that bull market, especially affecting those tech stocks. But now we're seeing the tech stocks pull back a bit, cool off. But certainly it's undeniable how strong Canadian banks have been when we look back over the last 30 plus years for sure. So just moving the conversation on. So Chris, could you provide us an update now? We saw those Q1 earnings roll in a few weeks ago for the big 6 Canadian banks. Could you provide us an update on earnings reports and how has this affected the sector year to date versus the broad market?
For sure. So yeah, like you mentioned, banks have been, real kind of had a gold star performance over the past year, kind of coming out of the pandemic. We note that there was less credit losses than expected, and that's been a theme of the past few quarters. That, with the support of government programs, with the support of monetary authorities, the pandemic challenge from the bank's perspective was managed pretty well. So they've had less loan losses than they expected to have, and as a result, some of those provisions that were set aside for the rainy day were released back into earnings. So that's been that's been a positive driver. And we also note the diversified business lines. So, if you look at it, any of these big 6 banks, it's not just about personal or commercial banking or lending. It's also about wealth management. It's about capital markets and trading revenues, deal making, insurance. So there's a lot of different moving parts under the hood. One thing that we've seen recently is that capital markets and investment banking revenue has been very strong as companies come back into the market to issue equities. Banks are often the trusted partner to help them do that. That's been beneficial. And with the volatility we've had, generally when we see higher volatility, we see a little more trading revenue as well. So that's been a beneficiary as well. And then last but not least, as interest rates have started to move up, banks can benefit from a lending perspective. They can benefit from a steeper yield curve. So yeah, just some of the factors, but overall been a very conducive environment for banks. This, we call in quotes, call it the economic reopening trade. With this renormalization, getting back to kind of normal things, normal activity, have certainly benefited the banks. So it was another very solid quarter for sure for the Canadian banks.
Yeah, a lot of tailwinds for Canadian banks right now with the rising yield curve and of course a little more volatility in markets, helping out those capital markets desks. So diversified business streams really benefiting the big six Canadian banks. So we've talked a little bit about the growth angle on the Canadian banks so far, but of course, Canadian banks are some of the most well-known dividend payers in Canada. Chris, can you just guide us through this slide here? Historically, what have dividends looked like for the Canadian banks and where are we sitting right now?
Yeah, for sure. And I think we've seen on a couple of the slides, we haven't, well, you mentioned it as well, right, Danielle, that the 15% hike, dividend hike towards the end of last year, the banks were not allowed to raise dividends during the pandemic, but then that exemption came through late in the year. There's a 15% increase in the average dividend yield. And, they're kind of back on track to what they've done for, literally decades, if not centuries. I believe BMO, I actually learned today, BMO's been paying a dividend since I believe it was 1829. So there's a fun fact for you, almost 200 years of dividends. But they're back on track now. As you can see, the average yield's 3.75. This is partly why they have earned that reputation over the years of being, quote unquote, sometimes I've heard them referred to as grandmother stocks but I think everyone can benefit from a strong dividend yield and strong dividend growth. And, that's certainly one of the most compelling stories. So, growth and income are two key components of investing, and banks have really shown that ability to deliver that. And, in terms of the forward looking on the dividends, like I said, there's no more restrictions now. We'll probably be looking for some more dividend hikes likely to come from the banks this year as we move forward. And that could well push that yield up closer to that 4% level as we move forward throughout the year. I think having dividend growth of 8 to 10% this year would be, totally achievable for the banks.
Yeah, we'll definitely keep an eye on that and what's to come for dividends for the banks. And I know analysts especially are keeping a pulse on it as well. So when we talk about sector investing, we usually like to see what the analysts are saying. So if I think I have a chart for analyst expectations. Here we go. Chris, you helped me pull this. This is really interesting. Can you just talk us through this and let us know what are the analysts thinking of the sector so far?
Yeah, for sure. So this is just a poll of various analyst price targets across kind of the major research houses. You'll notice that generally the research houses don't rate their own stock. That's why you see a couple gaps here. BMO doesn't rate BMO stock, or CIBC rate their own stock, and so on and so forth. But one of those things that we've talked to clients is, listen, banks are coming off a year of being up 40%, a very strong year. Some investors have been a little anxious about whether that trend will continue, but we talked about some of those tailwinds that are still in place, and here's an average price target of an increase of 10% on a price basis, a collective average of all these samples, and then you add that dividend of nearly 4%. You're getting a total return target of mid-teen percentage, which I think is very, it's a very healthy return target, and shows you, if this comes to fruition, there's still upside and, can be benefits to that in client portfolios.
Great, thanks so much for talking us through this really interesting numbers there. Now, just moving on to US banks. So we spent a little time going through Canadian banks, and of course, as Canadian investors, we're very familiar with the big six. But what about US banks, Chris? How does this look different, or does it look the same as the Canadian banking sector? Can you just walk us through the similarities and differences there?
Yeah, so similar. I would say US banks have a reputation, and the reputation is somewhat well-founded, of being riskier lenders if you recall in the financial crisis, Canadian banks were really noted globally for their strong capital positions, solid risk management, and they still have that reputation. US banks, some of them are a little more highly levered, have less capital, and that's part of the reason why you saw in the financial crisis, they're very volatile, and some of them, in fact, became insolvent and had to be taken up by other ones. But overall, it's still a place where investors can benefit, and particularly, in this backdrop where things are doing relatively well and reopening, and the economic activity is picking up, and the interest rates are increasing. U.S. banks are doing well, so I think it's a very nice factor to complement your portfolio. But just keep in mind they do carry a higher volatility profile. So you tend to need a little less weight in your portfolio. I think makes sense relative to Canadian banks. But U.S. banks, there's a lot of reasons to like them, and largely similar ones as the Canadian ones. I think just a little smaller weight in the portfolio for most investors probably makes sense.
Right. So U.S. banks being just a little more growth oriented, but along with that comes a little more volatility. Now, if we're going to start talking about, I think on the next slide, we have covered call options on the banking sector as an idea. If you're looking at playing the banking sector with a little more income, Chris, I would love if you could talk us through what a covered call, a bank ETF looks like, but also we just kind of explain that added volatility in the U.S. bank sector, what that translates to in the covered call version of the U.S. banks.
Yeah, absolutely. And so, let's just pick up on that U.S. theme. When you're selling covered calls, what you're doing is you're selling potential upside in return for income. And one of the factors that really drives how much premium you're going to collect is volatility. So when stocks are volatile, you can collect more income. So that's one reason in the US in particular, I do like this ZWK, which, as you can see on this chart, it's collecting about 8% yield within the portfolio. It's a very healthy yield, and a lot of that is because it's a little bit more volatile, the underlying. So it's a nice way to get exposure to the US banks, but also collect a high income stream. And then, on the Canadian side, ZWB is one of our signature funds. And again, covered calls really for clients who want that equity exposure, but they also want that high level of income. That's what they're designed for. So, whereas the yield on banks we saw was 3.75, the indicative yield on this ZWB is 5.8%. So obviously a little bit higher than the regular banks. So it's about adding to your yield, and that can maybe help you solve a cash flow requirement that you have within your portfolio.
Great. So a couple ways to play the banking sector using an ETF. You can go just straight up all long equities, get a banking sector ETF like a ZEB or a ZUB for US. If you're an investor that likes the cash flow, is more income oriented or income focused, you can look to a portfolio of bank stocks in an ETF with that covered call overlay to increase the income there, the cash flow there. And then recently, BMO we heard from investors who wanted exposure to the banking sector in the fixed income side of the portfolio. So we've just been talking about bank equities, but what about bank bonds? We know Canadians or Canadian banks issue, like they're one of the biggest bond issuers, right? In the corporate sector here in Canada, and for preferred shares, notably preferred shares as well. So we got together, we got our portfolio managers, Chris and the rest of the gang, and we figured out this ETF, ZBI. So it is for the fixed income side of the portfolio. It's bonds, it's preferred shares, and what this ETF looks like really is a bit shorter duration than the broad market, and that's just because the banks tend to issue shorter duration bonds than other corporations, but they're high quality assets because we've been talking about the banks, the blue chip companies, they're higher quality bonds, but it comes with a bit of a yield pickup versus the broad market. So focusing on those high quality bond assets, getting a bit of a yield pickup, and then a little bit shorter duration, which reduces interest rate risk overall. So a really interesting idea for anyone out there looking to add Canadian bank exposure to the fixed income sleeve of their portfolio. So I know we covered a lot today, so just to summarize, I have a few tickers here on the next slide. So when you're thinking about using an ETF to get bank exposure in your portfolio, you know, this is another a reason why we really truly love ETFs, and there are so many benefits, because within a single trade you get a basket of stocks, whether it's a basket of Canadian banks or a basket of US banks, and then you can really cater the ETF that works to your needs, whether you just want the straight up growth and income story with something like a ZEB, which is actually one of the largest ETFs in Canada. I was looking today, it's $2.8 billion in assets. So a lot of investors really across the spectrum, institutional, advisor, and direct investors at home looking to this ETF to get that exposure. Or if you're thinking about, you're an investor that's more focused on income, there's those covered call versions to get access to the banking sector. And then of course, ZBI to get access on the fixed income side. And as a reminder, a broad market Canadian ETF like a ZCN, still about 25% exposure to the banks, or 21%, I guess, as of the last week exposure to Canadian banks, which is still a healthy exposure if you are holding a broad Canadian market ETF. So just a couple tickers to consider that provide exposure to the banking sector. Now, thanks for the questions. We saved some time, as always, to tackle some of these at the end of each session. So the first question is on ZEB, that equal weight banks ETF. How frequently are the dividends paid? So for ZEB, we pay out the dividends monthly, just to provide that nice experience for investors who are looking for monthly cash flows. Canadian banks actually pay out their dividends quarterly, but then we just smooth it out and pay it out over monthly. And you can find that on our ETF website, or on our website, bmoetfs.com, and you can look up the dates when those distributions are paid. So thanks for the question. What are the benefits of buying an ETF hedged to Canadian or US currency? Chris, can you help us out with this one? What are some considerations investors should make when considering the currency choice to make on an ETF?
Yeah, so it's great question. You know, so it's good to remember that anytime you invest in a foreign asset, whether it's equities or fixed income, you know, there's currency exposure embedded in your total return. So as a Canadian, you're going to get the return of that asset in the local currency, and then you're also going to get that return of the currency as well, unless there's hedging involved. So if you buy a hedge solution, what that tries to do is remove the impact of the currency, so you're pretty much just getting that local return of the asset. You know, what we see is a lot of times on the fixed income side, investors prefer to hedge that exposure. So what you have in fixed income is a little bit lower returns than equities over the long time period, but what you can have is you could be earning money in fixed income, but if that currency moves the wrong way, you know, you could end up not making those expectations that you had out of that investment. So we do see a lot of hedging on the fixed income side, and then we also see it on the equity side as well. And you know, there's a couple different factors, but what it really comes down to is how you want to structure the portfolio. I would say one thing is that, you know, I do believe that the only free lunch in investing is diversification. And part of diversification is you can use currency exposure to your benefit. And where that really comes in, Danielle, is US dollars. So when you have exposure, say, to the S&P 500 or US banks for that matter, sometimes it's helpful to have that US dollar currency exposure, because what tends to happen in equities is when equities sell off, tends to, not always, but tends to, that the US dollar gains in value. So actually by being unhedged, it can help you shave off some of that volatility. So, you know, it's something you have to decide on at a holistic level. You know, obviously we're here to help, and we have, I'm sure, Danielle, we have other market insights segments totally devoted to the topic of currency hedging, and tons of resources on our website. So there's, you know, it's a big conversation. Tough to give a short answer, but the benefit is really that you can remove that impact of currency when you choose to do that. So, and like I said, sometimes having a little currency exposure is good, but like anything, too much of something can be not good as well. So, so it's you have to look at it a total perspective from the portfolio level and figure out what makes sense. But the nice thing about a lot of our ETFs is we have those tools to help you not just manage your equity versus fixed income allocations, but also manage your currency exposures by using hedged or unhedged products.
Thanks, Chris, for talking us through that. And thanks for the reminder, etfmarketinsights.com. We do have an education resource center, so check that out. I think we have a white paper up there on currency hedging. So give that a read for further information on that question. Are all ETF distributions made on a monthly basis? What are the tax implications on the distribution amount? This is a great question. Thanks for sending it in. So all the ETF providers' websites will publish a distribution schedule for the ETF, and it'll tell you if the distribution is going to be coming monthly. Sometimes the dividends come, or the distributions come quarterly or annually. So definitely part of your research when you are adding an ETF to your portfolio, find out how frequently those distributions are, because each ETF is set up differently. And then on the provider's website as well, you can find out how at the end of each year, how that distribution is taxed. And again, if you check out our resource center on etfmarketinsights.com, we have a really great piece, FAQ, a frequently asked question on taxes, and it talks you through all the different tax parameters and describes how each one is different. But of course, each ETF will be taxed differently depending on if it's fixed income or cover call or equity. But you can research all that information on our website and other ETF providers' websites. So thanks for the question there. I think we have time for one more question. Is there a BMO ETF for real estate investment? What's the ticker? Chris, can you help us with that?
Yeah, absolutely. So the ticker is ZRE, RE for real estate. So ZRE, it's one of our equal weight sectors. So it holds, excuse me, I was just pulling up the number there. It holds 24 different holdings in the real estate sector. It holds kind of a variety of them. So you got retail REITs, residential. So retail would be REITs that own shopping centers and the like. Residential, obviously, owning apartments. Industrial REITs, diversified REITs, an amount of office REITs as well. So real estate companies that own office space. Healthcare REITs. So it's a nice, pretty diversified mix of different sectors in that portfolio. And again, one of the equal weight approaches. And the nice thing about equal weight is, given there's 20 plus holdings, it's about 4.8% or so in each one. It doesn't have like one holding that is really heavy in the portfolio, so it's nice and spread out. And yeah, it's much like the banks, known for its income as well. Not as much capital return over the years as the banks, but certainly a strong income tool. So something that we see quite commonly used amongst our clients.
Thanks, Chris. Thanks for that. Thank you for the question. Keep the questions coming. I will say that we did get a lot of questions over the past few weeks on energy and energy sector ETFs. So instead of tackling them quickly here at the end of the session, we are going to bring you an entire 30 minutes next week on updates in the energy sector. We're bringing in a market maker from TD, that's Andres, and then Chris McKinney, one of our portfolio managers, will be joining us as well. We're going to get into that, so you don't want to miss that. Have a great weekend. Thanks for showing up today. We'll see you next time.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.